Investment advisory services are offered through Fusion Capital Management, an SEC-registered investment advisor. The firm only transacts business in states where it is properly registered or is excluded or exempted from registration requirements. SEC registration is not an endorsement of the firm by the Commission and does not mean that the advisor has attained a specific level of skill or ability.
Welcome to Navigating Retirement with Rick Durkee.
Welcome back to our mini-series about paying less in taxes in retirement with Roth strategies. I'm your host, Rick Durkee, president and founder of the Coastal Financial Planning Group. And let's continue our discussion today about Roth accounts, how to control taxes, and also paying less taxes in retirement. Now, so far in this series, what we've talked about regarding Roths is what is a Roth, the advantages of Roth, the differences between conversions and contributions. We've identified where each is utilized and strategies for each. Also, we've talked about how you can take advantage of current tax situations and take advantage of Roth IRAs. So now let's talk about the assumptions that are being made when you choose what bucket and you decide where to put your money as far as the future goes. Let's talk about a story. Let's say that you were going to mail yourself money into the future. How would you want to open that mail? Let's talk about an assumption where we chose to have tax-deferred money, like in our traditional IRAs. We are assuming then that taxes are going to be lower in the future when we open up that mail. Now, a second assumption is if we open that mail and we choose to put our money into a Roth, it's going to be taxed now when taxes may be lower, and then we're going to have tax-free money in the future when we open up that envelope. Taxes in this assumption are factored in that they will be higher in the future or perhaps the same. Now, the third assumption as we open that piece of mail is that we choose for this money to be taxable. This means that we might need that money sooner than later in retirement or our now bucket. We use the money now. In order to make this decision, you need to carefully consider all three of these assumptions. What factors could influence future taxes? Presidential elections, House, Senate, voting on taxes, the debt, the deficit, inflation, or we need to make sure that we're considering what your future goal is for growth of this money, most importantly. Now, what happens in each of these scenarios if our assumptions are wrong? If taxes go up when we think they're going to go down, if we assume that taxes will be lower in the future and they end up being higher, then we could, in essence, have less money than we thought. So we have to take all this into consideration when we're looking at the future use of our money. Taxes certainly play a critical role. We want to avoid money slipping through the cracks to the IRS wherever we can. We don't know what the future is as far as our certainty as to whether tax will go up or down in the future. So, to recap, the decision on how we save our money for the future should really depend on at least as much, if not more, of our expectations of the future and of what tax rates and what tax environment the future may hold. We also need to know when we're going to use this money. So the key here is that the tax rate when you use the money is more important than when you earn this money in your early savings years. This is a critical consideration when we're planning for your retirement. So in closing, assumptions are made all the time in financial planning. This is a critical one to examine. Maybe we need to rethink what we think we know now, and so stay tuned for our next video and learn how to pay less in taxes in retirement.
Catch more of Rick Durkee and Navigating Retirement by visiting cfpgroup.biz.
While we believe the information in this broadcast is reliable, we cannot guarantee its accuracy. Opinions expressed are subject to change without notice and are not intended as investment advice or solicitation for the purchase or sale of any security. Please consult your financial professional before making any investment decisions. Investment advisory services are offered through Fusion Capital Management, an SEC-registered investment advisor. SEC registration is not an endorsement of the firm by the Commission and does not mean that the advisor has attained a specific level of skill or ability. Investment in securities or the market involves a potential risk for loss of principal. Trading, therefore, may not be suitable for all listeners. Annuity guarantees are based solely on the financial strength and claims-paying ability of the issuing company. Withdrawals of growth from annuities may be taxable as ordinary income in the year it is taken. Individuals should review contracts for specific details of the product's features and costs. Early withdrawals may subject the owner to penalties, fees, or taxes.
Fiduciary duty extends solely to investment advisory advice and does not extend to other activities such as insurance or broker-dealer services. Advisory clients are charged a fee for assets under management, while insurance products pay a commission, which may result in a conflict of interest regarding compensation.